as rates potentially will come down, Federal Reserve may lower rates. What are you anticipating in net interest income for the current quarter and the rest of the year?
Yeah, so for fourth quarter last year, it was $14.1 billion. And then what happens is fourth quarter of 23 to first quarter of 24, you have one less day. And for that, believe it or not, that's like $100 to $150 million. So we're saying next year it'll be $13.9 to $14 billion, which is consistent with what we said last earnings call. And the interesting thing about that is since the earnings call in October till now, you've had the rate cuts in the market go from 3 to 6. And so, that's a major change in interest rates for 2024, and we still think we have the same trajectory. We come down a little bit in the first quarter, we bounce around a little bit down in the second quarter, and we start to grow out from there. And that stability is really the power of the deposit franchise starting to actually grow. We actually grew deposits quarter to quarter, the third to fourth, and it's very stable, and there's some seasonality in that, but we feel very good about that. And that's all advantage funding, which helps us grow the NII. But it's just a matter of, basically getting loans to grow, getting deposits to grow, but also just taking the effects of the squeeze from the Fed quit raising rates and the deposit pricing gaining for those deposits are more rate sensitive.
Brian, that's a lot riding on the idea that the Fed will actually start cutting rates in the first half of the year. And that's certainly what the market seems to think right now. But there are issues that could complicate that. Part of that is what we saw with CPI earlier this week. Obviously, PPI today showed that producer prices were down, but CPI was a little hotter and more stubborn than had been anticipated. And there are some headwinds out there, things like higher transportation costs. When you look at what's happening in the Red Sea, you saw oil prices up 4.5%, maybe better than that today on some of those concerns, too. If that starts to trickle back through into the inflationary costs and the Fed does not actually lower rates sooner, what does that mean?
From our company's perspective, that actually helps a little bit because the vast amount of short floating rate instruments we have from on the asset side and the cash, the $500 billion, almost $600 billion of cash we have that we put with the Fed overnight are in very short treasuries. But let's back up and talk about what we see in the consumer maybe and how we think that the market moved heavily. The Fed should stop. They've said they've stopped. Everybody said they stopped. And then they started putting cuts in. And the market has, as I said, 6 cuts in, and the Fed dot plots have 3 cuts. Our team has 4 cuts, Candace Browning-Platt's team. So if you mix that all together, at the end of the day, rates not coming down actually help us. But the reality is that everything's setting up for them to be able to normalize the rate environment, given that you're seeing consumer spending, which for the first part of 22 to 23 was up like double digits. It's now down to 4 or 5% growth. In the first part of 24, it's about the same. And when you think about that, we've been watching that for years and years and years. And as you look at that, that is more consistent with a lower growth, low inflation economy. If you think about, the consumer-driven economy in the U.S. in terms of the amount of impact they have, if they're slowing down their purchases, that's not inflationary. Now, we have to get through the housing rollover and the inflation statistics. You have the issues you're talking about. If gas prices kick up, the consumer feels that. The consumer's expectations have stayed in line. So I think there's still some tenuous ground here where we've got to make sure we get a sure footing. But I think the consensus view, what we see in our customers, what we hear from our commercial customers is they are basically planning for a soft landing, which is still a major step down in growth from the third quarter of 23 to the first quarter of 24. You're going to see growth from 4% plus to about 1%. That's a major downdraft in growth. And so the Fed at some point has to be careful it doesn't go below that. And these external factors could hasten them to do more faster, i.e. cuts, or cause them to hold on a little bit longer to make sure the inflation doesn't kick back in.